Hey guys, how's it going? I just finished up another Zoom call here, so let's see when Amanda gets here. Thank you guys for joining me every week. Really appreciate it. Hey, they are here. I saw you guys were at the Dodger game and I'm like, oh my God, are they gonna make it? I'm gonna make you guys co-hosts. Can everyone hear me okay?
Yes, we can hear you, Alex.
Okay, looks like a bunch of people strolling in. We're gonna give them a couple minutes. It's because we got a rock star guest this week. So
our Dodger game was actually yesterday. I
Oh,
just
wow.
posted it today. It would be fun to do a webinar from Dodger Stadium, though.
I was like, oh man, they're gonna be in the parking lot.
Stuck in traffic doing a webinar.
Right. Matt, how's it going? I don't think I've ever spoke with you before.
Good, Alex, how are you?
Good. All right. We're gonna give it a few more seconds here. Lots of people coming in. Thank you guys. Thank you for showing up every day or every week. If you guys get a chance, I'm gonna be streaming this live on Facebook. If you guys are on Facebook, share the video so that way more people, we could get our message out there to more people. I'm gonna try to go live on Facebook right now.
Is it sad if I don't know how to share it on Facebook?
You'll probably look under my profile if you see my profile, and then you'll see a share button or something like that. There we go. We are live on Facebook.
Nice. We have people joining from work, it looks like.
Yeah. Anyone on Facebook, type in your questions. We'll try to get to them. I don't see Savannah here, but let's go ahead and get started. So, hey guys, how's everyone doing? My name is Alex Sabio. I'm a respiratory therapist by trade. I created, along with Savannah, healthcare professionals investing in real estate. That's been a passion of mine for the last 9 months. It's taken up a lot of my time, but I enjoy giving a lot of value back to people. I started investing in short-term rentals about 2 years ago. And interestingly enough, if you guys ever listen to any of my podcast interviews, a lot of that has to do with Amanda. She kind of threw in this bone. She said, hey, you're thinking about becoming a real estate professional. You should think about getting into short-term rentals. I said, what the hell is that? I don't even know what that is. But she said, hey, there's a good tax benefit there. And some of my clients are making good money. And for some reason that kind of stuck in the back of my mind. And I was trying to do apartment complex and it just wasn't working out. And I said, hey, let me go interview more people that are doing short-term rentals. And the rest is history. That's really what it was. I was doing it initially for a nice tax break. Come to find out, it was making so much money that I just tried to get more and more and more. So that's kind of where I'm at. So, but yeah, without further ado, let's give it up for Amanda and Matt.
Wow, thank you. Thank you so much for having us, Alex. And nice to see all of you guys who are here with us. But yeah, I love that story. And I actually don't remember too much of the details of it. But yes, it's so good to see you, Alex, just really, taking off with the short-term rental, like you said, beyond just the tax reasons of doing it and now having this group and just helping so many other people, get started on doing the same. So we're really excited. Let's go ahead and get into tonight's presentation. So we'll share our screen and to talk about what are some of the tax strategies that we can look at for 2022. Yeah. PowerPoint slideshow. Yes, that one. All right. So hopefully you can see it.
Yes.
If not, let us know.
Yeah, so just a little bit of, thank you, Alex, for having us. I appreciate it. Thank you for those of you who are joining from work. Just what you want to do at the end of your workday is listen to the presentation about taxes, right?
We know
while
you're
you're still at work.
You're the dedicated one.
Right.
Yeah.
So, a little bit about ourselves. We are tax strategists and CPAs. We are a married couple, so it's not weird that we're sitting in the same home office. Okay. So, but, we're CPAs. We, probably, I don't know, 85, 90% of our clients are real estate investors to some extent, whether it's kind of, full-time doing, fix and flips, rentals, or, a lot of clients are, working and do kind of, the passive investing on the side, whether it's long-term or short-term rentals, all kinds of different, kind of runs a gamut.
Yeah. And also, in addition to being CPAs, we're also real estate investors ourselves as well. So we love working with clients because I feel like it's a two-way street. We teach about taxes and then we learn about real estate strategies from them. So I'm always curious, like where you guys are investing in, where you seeing the cash flow. And we have a passion for education. So our goal is we love participating in these types of events because we can help to spread the information about what are the tax benefits of real estate investing, because there's a lot of misinformation out there, a lot of missed opportunities, and that's what we're here to try to help provide some clarity to that, and then hopefully have time to answer your questions too. So let's go over the agenda real quick. We're going to talk about a little bit about the latest and proposed tax changes on what came out of the Biden budget for 2023 that came out just under a month ago. We're going to talk about taxes and its impact on your wealth building, and obviously potential strategies that you should know as a real estate investor. And we'll end with some key takeaways for tax planning.
Well, yeah, so I think first we kind of like to start with a question for you guys. I think is, question would be is, what do you think your biggest what do you think your biggest expense is each year? Maybe drop in the chat box. I think some popular Facebook. Some popular answers are, mortgage.
I know a lot of you are a healthcare professional, so maybe like student debt, student loan interest, maybe a big one.
A lot of you are married, so maybe some of you might say your spouse is your biggest expense.
Yeah, kids. But the facts are that the taxfoundation.org actually did a study a couple years ago. And what they had revealed was that actually the biggest single expense for most Americans are taxes. And in fact, Americans spend more money on taxes than they do on food, clothing, and shelter combined. So so that's something interesting, right? So for all of us who, work very hard in our jobs or in our business, but having a big portion of that lost to taxes. And, we are always talking about income taxes, right? Federal income taxes, for those of you who are in high taxing states like California, that's another big one as well. So, but outside of income taxes, there's just so many more things we pay taxes on that we don't talk about.
Yeah, I mean, there's, those of you with your own business, you're working for yourself, you're working for somebody else, you got payroll taxes, self-employment taxes, right? You've got, buy a product, you're paying sales tax. All this real estate investors, what's the big tax we pay? We pay property taxes, right? So when you stop and think and you add all that stuff up, it really shouldn't, come as a surprise that, our base expense is taxes. It's, but it was kind of mind blowing as a CPAs to kind of read this the first time too, but it's, when you stop and think about it, yeah, it adds up very quickly.
Yeah. And so you can see, if we are losing more than half of our money to taxes, but if we instead were proactive in figuring out the ways that we can reduce that, that would mean, more cash in our pocket that we could either enjoy, spend in our family, on our kids, or better yet, utilize that to invest in more real estate, right? In other words, if you save $20,000 in taxes over either 1 year or a couple of years, that $20,000 could be a down payment on $100 worth of real estate. So as boring as taxes might be, and I know you guys don't think it's boring because you're here at 5 o'clock. And, but, we like to just kind of put that in context that taxes don't have to be boring. It's one of the more powerful tools, especially for those of you who are investing in real estate.
Now, one thing to keep in mind, or one thing to remember, this data is from 2019. Now, I don't know how many of you guys can actually remember 2019. That sounds like a lifetime ago, pre-COVID, but that was back actually when we had a bunch of tax breaks under President Trump. But even in those years, taxes was still our biggest expense, right? So can you imagine what's this going to look like in the coming years if taxes increase, like a lot of people are thinking they're going to, a lot of congressmen or, the government is talking about doing, right?
Yeah. And so let's talk about, so this is where we were, like Matt said, right prior to all the, tax changes. But now let's talk about what might be coming up. These are, again, the latest tax proposals from President Biden's 2023 budget. And no, so a caveat to that, whether any of this passes, how the final form will be, we don't really know. But nonetheless, we have some insight into what he's looking at. So important for us to at least, get an understanding of what that is. So one of the first things in the current proposal is to increase individual tax rates from 37% to 39.6%. Not only is it a jump on rates, but also these higher taxes are starting at much lower income levels than where it is currently. So for single taxpayers, $400,000 of income. For married joint, it's not 800,000 for two people. It's actually only 450,000. Okay, so if you're someone who's married, combined if your income is 450, then you might be subject to this highest level of taxes.
We're not saying go out and get a divorce. So I don't want that to be the takeaway from today. But think about it though. Right now, the highest rate is 37% right now. And for a married couple, that kicks in when your taxable income is a little over $600,000. So not only is that going to go from 37 to 39.6, but as Amanda mentioned, it's also going to kick in a lot sooner. So at $450,000 instead of 600 or 610, whatever it might be. So they're kind of getting you two different ways with that one, right?
Yeah. And a huge marriage penalty, right? Like, so for married people, you don't get 800, you only get another 50,000 of a bump. So hopefully this doesn't pass. Another one that's currently in the proposal. And I don't know for any of you who are tax nerds, if you've been following, kind of tax proposals.
If you want to admit that you are. Right?
Yeah. These are very similar to what was talked about last year in 2021. What ended up happening was those kind of got tabled. And so we celebrated, we're thinking, all right, no tax changes, everything's great. And then fast forward to 2022, and now these are back again, right? So they're like resurrected from the dead. So here we are, facing the same issues. So the other thing is potential changes to capital gains tax rates.
Yeah. So, why do we care about that? Well, obviously as real estate investors, we got rental properties. We're going to sell rental property, looking at capital gains income, right? Or maybe you're, investing in the stock market and you're looking to dispose of some stocks. You're going to have capital gains taxes if you made a profit, right? So right now the capital gains rates are, 15, 20% for, most people it's 15%. On the higher end of your income scale, you might be paying 20% for long-term capital gains taxes. What they want to change that to is basically essentially tax for those people in the highest brackets, tax your capital gains at ordinary income rate. So essentially 39.6% instead of 20%. So obviously that's a huge change. Now they're talking about only having this kick in I think the latest one was if you make more than $1 million. But again, who knows if that's the final. They might take that last part about $1 million and just kick it in and say, hey, if you're in the 39.6% bracket, have any capital gains taxes, you're going to pay 39.6 on it,
Yeah, that's not impossible to happen. Seems like an easy change for the worse. And I know some of you who, have been in real estate for a while, obviously there's ways to defer capital gains if we do 1031 exchanges. And believe it or not, that is also, proposed to have some changes as well. Not as bad as what we initially thought. We thought that they would take away the 1031 exchange. And just real quick, for those of you who don't know, 1031 exchange is a tax benefit where the IRS allows you to sell a rental property. And if you have capital gains, you don't pay the taxes. You get to defer the tax on the gain as long as you reinvest it into additional real estate properties. A lot of different rules with respect to that within this strategy, but kind of that's a high level of what it is. So currently, if I sold a property for $1 million or $10 million of gain, I can defer all of it if I follow all the rules. In the proposal, they're looking to put a maximum limit on that going forward. And so if the proposal gets passed, it would be a maximum of $500,000 that we can defer per person. And as a married couple, for any of you who are married, it's $1 million that you can 1031 exchange. Anything above that, you just essentially pay taxes on. So that's another one that's, we are keeping an eye out for real estate investors, because if you're someone who owns real estate, a question to ask yourself could be, do I want to hold on to my rentals in the long term? or if not, if this is not a great property, I want to reposition to a different marketplace or just a different type of property, then you might want to do some planning to make sure you're utilizing all the 1031 exchange benefits before any potential changes would come about. Okay.
Now, another one that's to some extent is a lot easier for them to, sell out in the media because it doesn't talk about changing tax rates, is that the budget is actually, they want to set aside about, last I read was about $80 billion of additional funding they want to give to the IRS. Now, part of that would be used to kind of, improve IRS computers and programs and this, that, and the other, right? But a lot of it actually is they want to set aside to improve IRS auditing and increase the number of IRS audits. Because think about it from their perspective, right? This is almost like a low-hanging fruit. They can go after, if they can go after audits and successfully close audits and generate tax revenue that way, they don't have to go out and say in the public that they raise tax rates. They just were able to go out and, and increase revenue that way. So nothing to be scared of. It's just something to be aware of, that this is, potentially might be coming down the pipeline. Anytime that is in the works, and whether it is or not, you should still be making sure you're documenting everything, keeping good records, because keep in mind, if you're audited, it's not going to be next week or 6 months after you file necessarily. It might be 2 to 3 years after you file. And again, hard to remember what you did yesterday or this morning for that matter, right?
Yeah. Okay. So now that we've gone over all these terrible, terrible news of how much tax we're already losing, how much more,
shoot the messenger.
Yeah. How much more in taxes? Effectively, the Tax Foundation, they did another research on the proposed changes. And what they concluded was that if the proposed tax increases were to pass, the United States would have one of the highest top tax rates on individuals and corporations in the developed world. So very shocking, right? That we will be the leader in taxation. So, but here's the good news, right? Regardless of how taxes change, how much higher the rates go, there are always things that we ourselves can do as investors to protect ourselves. We might not be able to wipe out all of our taxes. There might be limitations still, but there are always going to be things that can be done. And all that means is as tax law changes, our tax strategies change alongside so we can get some of those benefits still. And the good thing about being real estate investors is that in the eyes of the IRS, real estate investors are also business owners as well. Okay, so whenever you hear people talk about, wow, being a business owner gets you so many write-offs and so many benefits, it effectively works the same way for real estate investors. So, one of the biggest ways or most easiest ways to reduce our taxes is to maximize our tax deductions. And I think for most investors, we're really good at writing off our property related expenses like interest, property taxes, mortgage, insurance, management fees, and all that. But what a lot of people miss out on frequently are the overhead expenses that real estate investors have. Again, as business owners. So as investors, we utilize our car for real estate, driving to local meetups, driving to look at properties, driving to go to the bank, Home Depot, right? All those car related expenses partially are tax deductible. And so make sure you track that, because again, as if your tax rate is going from 37% to 39%, right? That $100 is now going to save you a lot more in taxes than what it was before.
Yeah, I think, looking at deductions, some of the ones that I think, based on our experience, what we see a lot is that, overlooked, I guess, would be, home office expense. That's from a deduction standpoint, that's a low hanging fruit that it's not that hard to qualify to have a home office. And if you do have one that, you run your business out of from your house, don't be afraid to take the deduction. I mean, there's still myths out there that, even though this home office deduction came out 20 plus years ago, that there's people that still think this is a high audit risk item. And it's very far from the truth. I mean, the IRS a couple of years ago actually made it a lot easier to take the home office deduction by coming up with a standard deduction for it if you didn't want to go through the trouble of tracking all your own expenses. So I think that's one myth with the home office. Another one is that we see a lot is that people think they need to have it needs to actually be a clear definable room or something. That's the home office. And that's also not true. You just need to have a clearly definable space that's used exclusively for business. So we've seen it where people have offices at, at the end of a hallway, it's just it might be a small space, but it's still a qualified office, right?
Yeah, or part of like we see a lot like in the people who have a master bedroom, but maybe they have like a little alcove area that is their home office. So that works out as well. The more expensive your home or your rent, the better the benefit, right? Because what you're doing with the home office is you're deducting a portion of your household expenses that you naturally have already, right? As just, someone, we all have housing expenses, whether it's a mortgage or you're renting your primary home. We all have utilities that we pay. And these are things that are typically not deductible just as a regular individual. You can't write them off. But if you're a real estate investor, now you can start to shift some of those expenses into tax deductible items. So, if my household expenses $10,000 and I'm using my home office, 20% of that is home office, that could be like a $2,000 tax deduction. Right. And again, if you're at 50% tax rate between federal and state, that's a pretty significant saving in terms of cash. For those of you who I know, a lot of you guys are in the healthcare profession. So having an office that you work from at your day job does not prevent you from claiming a home office. They're totally unrelated, right? So your home office is where you're doing your real estate investing business. And so those are deductible, even though on a day-to-day basis, you might also be going to another office location for your job.
Yeah, again, I mean, it's not extra money you have to spend, right, to get a tax deduction. This is money you're already spending, and it's a way to kind of transition from non-deductible things into deductible expenses. Amanda mentioned the kind of the car earlier, right? I mean, that's a great example of everyone's obviously using their car to drive to and from their day job, or driving it to look at properties, or manage your properties, what have you. You can start tracking your mileage, and at the end of the year, if you're using your car 50, 60, 75%, or even more of the time, percentage of the time for business, you can take deductions for your vehicle through either, actual expenses, standard mileage. Actual might include depreciation expense in your car.
Yeah. And this year, we'll talk about depreciation in a moment, but right now there is a bonus depreciation at 100%, which just means that for certain investors, if you're utilizing a car that's primarily used for your real estate business, the write-off can be very, very significant. Again, it comes back down to how much business use you have. But in an extreme example, if it's a car that's 100% business use, you may be able to write off up to 100% of a purchase price of a car this year. So, again, these are things to make sure, regardless of how tax law changes, these are still going to be tax deductible items, right? The other big one in terms of deductions that we always talk about is income shifting. So for those of you with kids or even aging parents who might be able to help out in your real estate business, the strategy is to simply hire them in your business. Hire them in your business to help with your real estate activities, which makes the money that you pay them for those services tax deductible. So if you're someone in the 37% tax bracket, and you're paying a child or an elderly, a retired parent who are paying low to no income taxes, whatever you pay them could be a 37% tax write-off in terms of saving you that amount in cash, right? So this is another one that we see quite a bit. If you paid your kids $5,000, it might save you up to $2,500 in income taxes, right? So pretty powerful.
And again,
stuff.
it's coming from the thought process that if you're already financially supporting these people, let's find a way to get them to help you in your business. And so that money you are giving them, we turn it into, you're paying them for their work they're doing, and now it's a tax deduction for you. And again, if you're at the higher bracket and they're at zero or a low bracket, as a family, you come out ahead, right?
Yeah. Yep. So we just wanted to share this next slide with you guys. It's just something interesting. These are actual expenses that IRS upon audit disallowed certain taxpayers, and the taxpayers took them to tax court. And these are examples of things that the court has allowed taxpayers to write off. Now, the caveat here, though, is there's certain instances where these were reasonable business items for these particular taxpayers. So meaning, we can't all write off wigs or pet food, but in the right circumstances, those things could be tax deductible if they're ordinary and necessary with respect to your particular business. And so a good habit to get into when you're meeting with your tax person during the year is to ask, if you have a large expense on something or other, ask them, not can I write this off, but how can I write this off? right? So I'm going to Hawaii. I want to go to Hawaii in a couple of months. Can I write off my trip for my vacation? No. But what about if I'm going to Hawaii, how can I write that off? Well, the question might be, Alex, what are you going to do in Hawaii? Are you going to do any real estate? Can you plan for real estate things? Is that a possible place that you might invest in, right? And ideally, maybe you even end up investing in it. And so these are things to kind of, shift your mind frame a little bit, ask the right questions so that you're putting your tax advisor in a more proactive mind frame. And a couple of these items listed are actually from real estate investors too, because real estate investors are some of the most creative people that we know.
Yeah, I think the private plan was a real estate investor felt like he needed to have a plane to fly around the country to visit his properties, and I guess the tax court agreed with him.
Seems reasonable to me, I think.
Yeah, I think the girlfriend was related to real estate too. Somebody was paying his girlfriend to help manage his properties, and he was paying her, and the IRS said, "Come on, you're just giving your girlfriend money." But when they went to court, he was able to show a lot of documentation that showed that she was actually doing work and helping him. And we were at a presentation once where it was like the very end of it. We ran out of time walking off stage, and someone's like, "Hey, tell me about the girlfriend." I don't know, thinking about it, blurted, he was paying her for services. And that's, probably not the best description of that. So, but anyway, it was deductible, whatever it was for.
All right. So let's talk about legal entities. I know this is a kind of a frequently asked question, especially for any of you who are newer investors. Amanda, you keep talking about business, and I'm a business owner, and that all sounds great, but I don't have a business. I don't have a legal entity. Does it mean that I don't have any write-offs? And I really wanted to clarify, when we say you're a business owner, it just means you're in the business of investing in real estate. So you're a landlord, or you're operating a short-term rental business or something like that. That's what the business is. We are not meaning business in the sense of legal entity like an LLC or a corporation. Okay, so those common expenses that we just talked about in the prior two slides, you can take advantage of most of them regardless of whether you have an LLC or a corporation or not. And in fact, for landlords, again, whether long-term or short-term rental operators, all the expenses are pretty much going to be deductible in either case, with or without a legal entity. The reason you consider have legal entities is so that you can get asset protection. So for landlords, effectively the benefit is from a liability perspective, not from a tax perspective. Now, it doesn't mean that you don't have to talk to your tax advisor about it and just go ahead and form a bunch of entities, because entities sometimes come with very high costs. There are formation costs. There are annual fees you pay to the state. And for any of you, wonderful people in California has $800 per LLC per year. So these are all the different costs that we want to consider before actually forming an entity.
Now, keep in mind, obviously, there's no one size fits all for everybody here, but it just, keep it simple from, 30,000 foot level, because we do get this question a lot. For rental properties, generally speaking, we see most people use LLCs. They work really well for asset protection reasons. They work really well for tax purposes because it's easy to get properties in and out of. But again, think of the cost of formation and think through all that before forming it. Now, on the flip side, for kind of active real estate income, like your fix and flip, your wholesalers, property management fees, maybe you got a property management business, your realtor, generally speaking, an S corporation is going to work best. The reason for that is it can give you the ability to save some taxes through minimizing self-employment taxes. Because if you weren't operating as an S corp, you're probably operating as a Schedule C sole proprietor, and you're going to be paying self-employment tax on that. So working it through an S corp generally gives you the ability to kind of minimize some of your self-employment taxes that way.
Yeah. I think one tip I just want to say is, for the most part, because I see this mistake all the time, it just really hurts my heart because it could be very costly for taxes. I just saw another one yesterday. So when you have rental properties, okay, whether long-term or short-term, you generally don't want that in a corporation. Okay, you want that to be in some kind of an LLC, because it's very detrimental to be holding these inside corporations. All right, so we can't talk about real estate tax benefits without talking about depreciation. And I know some of you probably have a great understanding of it. Some of you might be a little bit new to this. So we'll kind of go over the basics of what is depreciation.
Yeah, I mean, depreciation is probably our favorite strategy, loophole, whatever you want to call it from a tax perspective. It's basically the IRS giving you the ability to write off a portion of your purchase price of your building over time against your taxes. Now, we call it a paper loss because it's not necessarily something you're paying for out of pocket every year, right? You buy a property, there's a down payment, you might be using leverage, but you're getting to write off a portion of that property against your income every year. Beauty of that is that this is very unlike investing in the stock market, right? You go out and buy Google, Apple, whatever you want to buy. You're not writing off a portion of your Google stock every year. You don't get to write that off until you actually sell it down the road. So that's the benefit that we can use depreciation to kind of shelter our cash flow, if you will.
Yeah. And then, generally speaking, for a rental property, you can write off the purchase price of the building component over 27 and a half years, which means you're taking 1/27th of a write-off every year. And this is eligible for you regardless of whether the property goes up or down in value, right? It's just based on the law that says you can write off part of the building every single year. But there are things that we can do to accelerate the write-off of that building by breaking it out into components. And that's called cost segregation. And the benefit of a cost segregation is taking that building and breaking it down into, flooring or specialty plumbing and cabinets, and then taking a faster write-off on those different components. The great thing about 2022 is this is the last year of 100% bonus depreciation, which means that we're kind of supersizing the depreciation benefit in this particular year. So I think the easiest way to kind of demonstrate the power is to go over an example of how cost segregation works. So let's say you buy a rental property, it's a $150,000 rental property, you put $30,000 down, right? The rest you finance with the bank. And let's just assume for simplicity, the value of the building you bought is $100,000. Now with cost segregation, again, separating the components, nothing that you have to do, it's something that your CPA and an engineering firm can do. By splitting it out, the first year depreciation might be as high as $30,000. And so you can see how like a $30,000 down payment, your write-off in itself is the entire amount. So this means that you have $30,000 of paper losses that can be used to offset the taxes from your rental income. So very, very powerful tool for this year.
Yeah, and again, you're in a high tax rate, 50% tax bracket, and you're able to use the loss to offset your time. I mean, that could save you, $15,000 in taxes. If you're a real estate professional and you're able to use that loss to offset your income, it's a huge advantage when looking at tax planning.
Yeah. Or if you're not a real estate professional, but like Alex said earlier, right? If you're someone who's still working full time, but you're doing short-term rental properties, right. And if you're very actively involved and you meet some of the material participation requirements, you can also utilize that to offset W-2 income as well. What we like about the material participation is those are the hours of both spouses, if you're someone who's married. So it's a lot more flexible than long-term rental properties. Right? All right, so let's go over real quick retirement planning, because I know a lot of you are, still working in the medical field. And another mistake we see a lot is people just liquidating retirement accounts to then use it for real estate. And one of the potential downsides of that is if you're someone who's under retirement age, not only do you have to pay taxes, but there's also penalties when you liquidate retirement account when you're still young. The better way to consider using retirement money for real estate is to do self-directed investing. Okay, that's a tax-free, penalty-free way for you to move money in a current IRA or a 401k from maybe like an old employer. And maybe even for some of you, you can access from a current employer. But effectively, the steps are, instead of taking the money out of retirement, we are rolling it over into another retirement account. And the only difference is that other retirement account, we can do self-directed investing. Self-directed investing simply means that instead of being with, Fidelity or Schwab, where I have a portfolio of stocks to choose from, I'm able to choose from other assets that I want to invest in. And that could include rental real estate, could be a property on Main Street, it could be a short-term rental by the beach, or it could be a note investment or an apartment syndication, right? So the, kind of the possibilities are endless when we do self-directed investing.
Yeah, now sometimes the places where we see this can work is, again, maybe you've got, maybe you recently changed jobs and you've got money sitting in a 401k from your old employer, and they're giving you X amount of time to either roll it into something else, take it out, whatever. They're giving you the options, right? Well, that'd be a good time to look at, maybe moving that into a self-directed IRA. So now that IRA is not stuck in your new employer's 401k account. Now you have the option to choose what you want to invest in. Some employers will let you do rollovers while you're still working there. Not as common as we'd all want it to be, but it could be a possibility.
Yeah.
You can also borrow from account too. A lot of times you can borrow from a 401k as well.
Yeah, borrowing from a 401k is a great alternative if your current employer does not allow you to do a rollover, because that's another tax-free, penalty-free way to access that money. So, something to consider. Okay. All right. So I see some questions coming in. We'll have plenty of time at the end for Q&As. But we wanted to go over an example. How many of you have been told this, right? The more money you make, the more taxes you pay, right? And so let's see if that's a true statement. There are these three individuals. New York Times came out with a piece of article on them at the end of last year that said that based on analysis of these billionaires, Elon Musk, Bloomberg, Bezos, these people paid less tax, very little to no federal income taxes. And
now you think they'd look happier if that was the case, right? I mean,
yeah. Well, I mean, the piece was supposed to make them look like bad people who don't pay taxes, right? So how do they do this? Well, according to the article, they use strategies that were perfectly legal. Some of these very advanced strategies like borrowing from their assets without paying taxes. Hey, that's what we can do as real estate investors, right? Our properties appreciate, we borrow against it. That's not taxable income. They're able to write off interest on their loans. Same as real estate investors, right? We can do the exact same thing. They were accused, I don't know if it's accused, but it was said that they were able to sell assets and pay little to no taxes on that. So, sounds super advanced. Not really. We can do the same thing with a 1031 exchange that we talked about earlier, right? Real estate grows, we sell, and we don't have to pay tax on it. You can defer it. So here's examples of how some of these things that maybe are, supposed to be for the super wealthy are actually readily available to real estate investors like us, everyday average investors. And these are actually things that are utilized all the time that we see.
So you guys actually may be able to relate to these people more than you might think, right?
Maybe one day we'll see one of your faces on a New York Times article, right? All right, so to wrap it up, let's talk about tax savings in action. We wanted to go through an example. We talked about all these strategies. How does it actually work? I actually just updated the slide today before our webinar presentation tonight. So
these are all Alex's numbers.
This is not Alex, but similar. So this is a husband and wife client of ours for 2021 tax return we did recently, both working in a medical profession. Wanted to find someone that, relatable, right, for our audience today. So they started investing locally. They're California residents. They started investing locally in Big Bear and bought 2 rental properties during the year. Fairly decent cash flow. They bought it towards the end of the year, so not skyrocketing numbers. This is only for a couple of months. Did really well over the holidays, as you can imagine. So 26,000 of net rental income. Okay, so net, and this is after mortgage, interest, taxes, and all that. We just summed it up for you. So 26,000 net. They have 2 kids they were able to help a little bit in their rental properties. Again, this is end of the year, so the kids didn't get to do too much work. So they did some income shifting strategies we talked about, paid their kids about $2,000 for helping them with their real estate setup. Okay. They also had a home office and they tracked their mileage for their cars. So between car and home office, they wrote off about $7,200. Okay. This is just a normal person, didn't go out and buy a Tesla or anything like that. Just regular car they've been driving, just started tracking their miles and tracking the home usage. Okay. The biggest benefit for this particular couple was the depreciation, right? Look at Alex's face smiling. I like that. He has this huge smile. So for this particular couple, again, 2 rental properties locally, bought at towards the end of the year, they had $245,000 of depreciation. Okay. And because for them, this was a short-term rental, this couple, they decided to do most of the work themselves. So they bought the properties, they furnished it, they did all the staging. They had cleaners come in and out, but for the most part, they also actually self-managed the properties too. And so they were able to use the rental losses to offset not just the rental income, but also their W-2 income too, right? So the total deductions reduced their income by over $254,000. And so you can see, right, income went from over 300,000 down to around 91,000. That's a tax savings of over $60,000 for this particular couple.
You can kind of see why, investing in short-term rentals is probably one of the biggest or favorite things our clients are doing right now. Not just from the cash flow, and obviously their properties are appreciating and doing really well with people, because of COVID wanting to, still travel, but maybe not stay in a hotel, last year or whatever. Right. But also from, tax savings perspective, they were self-managing it. They were materially participating, like we talked about. So they were able to take advantage of all that good stuff.
Yeah. I mean, 60,000 in tax savings, that could be down payment on another $200,000-$300,000 worth of real estate, right? So you can see how important it is. But, the most common mistake that investors make that we see all the time is not understanding that tax return filing and tax planning are two totally different things. So this couple, they didn't just happen to fall into the $60,000 tax savings, right? They did proactive planning during the year. They met with us and we talked about what are the things that they should be doing. They had to be tracking their expenses to know what they are to write off. They can't just make it up. They had to track their hours so they know how much time they're actually spending in real estate. And of course, most importantly, they have to actually buy real estate, right? Have to actually own and operate real estate. If they didn't have that, then all of this just in theory is not really going to help you much. But it's something really important to understand. If your current CPA or your tax advisor is helping you with proactive tax planning, then that's great. Your job is simply to make sure you update them on what you're planning on doing, and then they will fill in the blanks to help you with what you should do. If your current tax person does not do tax planning, then it's important for you to seek out someone who does, right? Because those are two very different things. Planning is understanding what you should do during the year, so that by next April, you are maximizing your tax savings, right? And so we put together this little light bulb just to show you a summary of like the various things we talked about to save taxes, right? Maximizing our write-offs, shifting the car, home office, cell phone, that kind of stuff, shifting income to kids or other family members that you might be helping out financially in lower tax rate. Oh, sorry, that's our son screaming by if you heard him. Legal entity we talked about, and then retirement investing. These are kind of the four pillars that you want to consider. Okay. And we wanted to invite you guys before you go to the Q&A to invite you to, if you want more information, like I want to know more about income shifting. What do I need to do? How do I pay them? What should I be asking for legal entity structuring, things like that. You can download, we have a free ebook on our website. You can go to keystonecpa.com and download it, or I created a QR code today. So I don't know. I don't know if you
big time.
I've been using QR codes like at the restaurants. It's so I figure, hey, we'll do it for our webinars too.
Just don't ask me how to use one.
Yeah, you can check it out. And if ebook is not enough, you can always check out. We wrote a book. It's on Amazon. You can get it there. It's called Tax Strategies for the Savvy Real Estate Investor. Very long name. Tax Strategies for the Savvy Real Estate Investor. All right, so let's go to Q&A, shall we, Alex?
Yeah, hey, thanks so much for that. That's crazy because people always ask me what receipts do I need to save and all of that.
Trying to be a comedian. I think you're on mute, unless I can't hear you.
Oh no, he's not on mute. I can hear him.
You can hear him? I can't hear you.
And I always say, hey, depreciation is going to be your biggest, tax advantage there. And
yeah.
So my first short-term rental gave me a $207,000 deduction year one. And at that point, I was I need to get as many of these as possible.
Exactly. And you use your tax savings to, fund more real estate. And then, at some point, work becomes,
You buy more real estate, have more deductions, more cash flow. So it's kind of like that's kind of how I've been able to grow so much, is once I finally understood the tax strategies, these legal tax loopholes here, I was able to grow really fast. So thank you for that. That's all you. So
no, it's all you. Like I say, you guys have to actually do the things. You have to buy real estate and do all this, right? All right. So let's go to Q&A. Should we open the chat box?
Yeah, I'm pretty bad at this here. Let me try to read.
Okay, yeah, we can.
If anybody out there wants to unmute themselves here, But one of the things someone was asking is it has to do with recapture depreciation. So I'm kind of thinking about that right now. Like I bought a short-term rental in December of last year, and it's not performing as well as I would like, and it's gone up significantly in value, but I've done a cost segregation on it. I mean, do I have to hold that for a period amount of time? And if I do a 1031 exchange into something else, I mean, does that avoid paying the recapture tax?
Yeah, great question. So whenever you sell a property, if you're not doing a 1031 exchange and you have capital gains, then there is recapture taxes. In a simplistic form, what that means is if I bought a property for $100,000 and I already wrote off 20,000 of depreciation, right? Now my basis is 80,000 because I already wrote off 20,000 of it. Okay. So when I sell the property, my gain is going to be the sales price minus 80,000. It's not going to be gain minus 100,000 because I already wrote off that 100, right? So, and that's what they refer to as recapture. It's just basically saying you don't get to write off that cost basis twice, only write it off one time. But to answer your question, yes, if you are selling a property and you are going to do a 1031 exchange, then generally speaking, you get to defer that capital gains, which includes deferring the depreciation recapture, so that you're not paying taxes immediately on that recapture. Okay.
Nice. Music to my ears here.
Yeah. but nonetheless, if you're still doing it, this is for anyone else too, right? If you're doing that, make sure you reach out to your tax advisor so they can run the numbers for you and, make sure you're meeting all the rules and requirements for a 1031 exchange as well. Okay.
Right.
Can I build on that question? Can you do a cost seg on the new property that you 1031 into?
Yes. So great question, Michael. Yes, you can do a cost segregation on the new rental. In fact, it's suggested to do it to defer the capital gains. Now, whether doing a cost seg on the replacement property will get you more benefit or not, it depends on the 1031. So as an example, if I sold my first property for 100,000, I buy a replacement property for 100,000. I haven't traded up, probably won't get a new benefit. But if I sold my property for 100,000, I buy another one for 150, right? I've now traded up by 50,000. I do a 1030, I do a cost segregation. I'm going to get some added benefit because I've increased my investment by 50,000, right? So that's why it's typically suggested to do
that. Someone asked, how old does a child need to be before I put him to work?
So it's a good question. So one way we look at this is, you see diaper commercials, right? Kids are working; those kids are getting paid. Now, absent that, from a tax perspective, really the IRS just says that what you pay them or how much you pay them needs to be reasonable for the work that they're doing and their age and their skill set. So, obviously you're not going to have your 6-year-old be your IT consultant, but a 10-year-old or whatever, there's lots of things a 10-year-old can do nowadays, right? So it just needs to be reasonable for what they're doing. Now you might want to check your own state. Obviously, their state laws may have some law about kids working or not, and
number of hours. The younger your kids, the more restrictions there are legally in terms of how many hours they can work. For really young kids that, like, I don't know, babies to, maybe 4 or 5 years old. I think typically you're really limited to what you can pay them for. Sometimes we have clients who pay them for like modeling and things like that. But when you're talking about shifting like a significant dollar amount, it's going to be for the older kids, right? Ideally, like the teenagers, like maybe, 12, 13, 14. But of course, it's also very different child to child too. Some people have their kids are really young and very capable of doing things. And we've seen some, teenagers who really can't handle much of anything too. So it's going to be dependent. But at the end of the day, the key things to consider are that what you pay your kid has to be reasonable for what it is that they're doing. Meaning, if it wasn't my child doing this, it was the neighbor's kid doing it. Is this a reasonable dollar amount that I would pay that particular person? Okay, so if I would pay a neighbor's kid, $15 an hour to cut my lawn, that's what I should pay my kid. I'm not going to pay my kid $30 an hour, right? Unless there's some other reason why that is justified because your kid is so good at doing that or they're doing something special.
Okay.
I think Chris says
question.
if you pay your child, you need to claim, and do they need to claim anything? So Chris, it depends on what it is that your child, how much money they're making and how you're paying them. But generally speaking, right now, at least for income tax purposes, income under $12,000, they don't have to pay income taxes on.
I have a question to build on Alex's question.
Okay.
If say I'm looking at a new purchase that I may have to sell due to similar circumstances, would it be a bad idea to do the cost segregation? Because I did do it last year and it did help me tremendously. Thank you for the strategy, by the way. And I'm just wondering, is it best not to go there all together? And then on top of that, if you do the cost seg and get bonus depreciation, and say you sell and you roll into an opportunity zone, is there a gain there, or is it the same as 1031 in that?
Okay, yeah, it's a good question. So generally speaking, not recommended to do a cost seg on a property that you're planning to sell within the next 1 to 2 years. It's just one of the, obviously
If you're not going to 1031.
Yeah, if you're not going to 1031, but big picture, you're part of the benefit of cost seg, you're getting the present value savings over time of getting deduction now versus later. Doesn't say you can't do it. Obviously, it's just generally speaking, that's what we see. But if you do a 1031, there's ways to minimize the recapture, as we talked about. To your other question, if you're going to do a cost seg, sell a property, reinvest in the ozone, yeah, there's all that gain, even from the excess gain you're getting because you depreciated the property. It's still considered Section 1231 gain that can be deferred by investing in an ozone. So you should be able to avoid the recapture if you were to meet all those ozone reinvestment requirements.
I do want to do a caveat. The opportunity zone it only helps you to defer your tax until 2026.
Sure.
So in 2027, when you file your 2026 tax return, you do have to pay taxes on the gain. Right? It's a little bit different than 1031 exchange. All right, who's FG says pick me? Oh,
Guys,
Federico. Yes.
Um,
Okay, you said pick me. What's your question?
yeah. So he kind of answered my question.
Okay.
I bought a short-term rental last year, thanks to Alex. And I've got a lot of equity already into it. And I was thinking of selling. I did a cost seg at 1031 next year into something bigger, better. I understand 100% going to go away. So what is going to be the new number for bonus?
So the bonus depreciation, you're talking about bonus depreciation right now. It's 100% for 5, 7, 15-year assets. Next year, it's set to go down to 80%. And then the year after that, it's set to go down to 60 and then 40 and 20 and then go away, whenever that works out in 5 years or so. Now that's the current law. Now under Biden's proposal, a year and a half ago, there was talk about changing bonus depreciation. In the most recent proposals, he hasn't brought it back in, or they, I'm not saying he, but they. Doesn't mean it won't be brought back in again, but under the current law, bonus depreciation is set to go down by 20% each year starting next year.
Got it. Appreciate it. Thank you.
All right, so I think we have two questions similar. One is from Eric and one is for Sujatha. So I think this was for the client scenario we shared. So the question was, did they do cost segregation on both of their short-term rentals? And also, how is depreciation such a high amount in the first year? So yes, in that particular example, they did cost seg on both short-term rentals. And that's common, for this person. If you're meeting material participation for both rental properties, then you can do it for both properties. And because they had high income, it made sense. They wanted to accelerate both together in year one rather than do it 1 year and then the other one in the second year. The reason depreciation was high is because they did cost segregation. So effectively on that building, with the cost segregation, it was broken down into its components. So some of the components were eligible for 100% write-off, right? Because right now, any asset that's 5 years, 7 years, 15 years, common examples would be like, flooring, cabinets, all the appliances, fixtures, all the furnishings that go into the short-term rental, right? A lot of those things are eligible for 100% write-off immediately. And that's the reason that we see very high depreciation in the first year. Okay. 1-year-old income shifting. Yeah, maybe like I said earlier, but maybe not, probably not a very significant dollar amount.
Amanda, on the cost seg, would you mind explaining one more time? So if you did a cost seg and bonus depreciation on a property, and then you do 1031 into another property, and then you plan to do cost seg on that second property, how does this work? You said that it may not make sense, or that it has to be, that property value has to be larger. I thought that it was the same rule of where you would be able to do, I don't know, 100% or 80% bonus
Sure.
depreciation on the second asset. Maybe you could just like an example with
Yeah.
numbers or something.
Yes.
It's more clear
And
to understand. Thank
this
you.
is a common confusion point. So at the baseline level, sorry,
Smoke alarm. That's awesome.
turn it off.
You can try.
Okay, let me mute ourselves so we don't make. Oh, okay, we did it. Phew. Nothing's blowing up, huh?
Nothing's-
We're just surrounded by
No
smoke.
fire or
Even like,
anything.
hey, can't see us. Okay, so it is a common misconception or common question people have. So at the heart of it, the way a 1031 exchange works is to say, I have a property I bought for 100,000. I'm selling it for 150, right? I have 50,000 of gain, but I'm not going to pay taxes on it because I'm doing a 1031 exchange. When I roll it over my new property, if I bought it for the same 150,000, my cost basis is still 100,000. That's my basis in the old property. Okay. In other words, because I didn't pay taxes on the appreciation of my first property, I don't get new basis for it. And so if I sold my property for 150, I bought another one for 150, I haven't traded up, right? I haven't spent more money. And so my basis in my new property is the same as my old basis. And when you do a cost segregation, typically that's done just to avoid recapture taxes. I'm not getting another cost segregation on $100,000 of new basis because it's not new. I've simply sold one thing and replaced it with something of equal, right? Of equal value. The example I was talking about earlier was if I sold for 150, but I bought something for maybe 250, right? So now I've traded up. I have another $100,000 of real estate, of new real estate. If I did a cost segregation on that property, I have another $100,000 I can work with. And it's only the 100, it's the up, it's the increase from sales price to purchase price. That's new basis. That's the kind of the simplest way I can explain it. But yes, when you have new basis, you do a cost segregation, bonus depreciation, it works exactly the same way.
I see. But in this case, when you go from $150,000 property to 250, and you do a cost seg on 250, and let's say it's 25% of that value, so that would be like $60,000, let's say. So would you be able to take advantage with 100% bonus depreciation of that 60K?
So I just want to clarify, in that example, I've sold a property for 150. I've bought something for 250.
That's right.
My new basis is $100,000, right? Not 250. My new basis for cost seg purposes, it's 100,000.
Yes.
And so, yes, so from that, then you're looking at, breaking down the components and things like that. There's other things that, we do, the nerdy stuff. We do what's called fresh start election to kind of reallocate things to get the most benefit. But that's something that your CPA will be doing. You don't have to worry about any of that calculation.
But in this scenario, because you're more limited, is it that you'll more likely not need the cost seg than needed for, if you're trading up, but not significantly? So it's like, I don't know, usually they say cost segs make sense if you're buying something for 500K or more, but like in your example,
oftentimes you have to do a cost segregation so if if the relinquished property you did a cost seg on, most of the time your replacement has to have a cost seg done. It's just kind of a technical thing, not always, but oftentimes that's how it works.
The other deciding factors would be whether you need to use the deductions or not, or need the deductions, right? Depends on your income, depends, a lot of things. So
yeah.
I see.
All right. Thank you.
Maria asked, can you do a cost seg and bonus depreciation if you use part of your house for a short-term rental and materially participate in it? Yes, you can. So if you have, you have a part of your house you're renting out, or maybe you got an ADU, separate structure in the back. Generally, you just you allocate your purchase price for your house among, based on square footage, and then the percentage that goes of purchase price to the short-term rental part, you can do a cost seg and depreciate that.
Yeah, this is tricky though, because for mixed use properties, there's a big distinction when it comes to renting out a room in your home versus renting out like an ADU with a separate entrance. It is treated very differently for tax purposes, but yes, it is possible to do that. Now, whether you should or not, right? That's kind of going to be the key in looking at the different scenario. Sharon says, is it too late to do a cost seg for 2021 if we haven't done the taxes? No, not too late at all. So you can still do it anytime before filing your tax returns.
De La Cruz asked, using the cost seg strategy, is there a problem doing Schedule C versus Schedule E? I thought rental should be on Schedule E. So this probably is related to short-term rentals. Most of the time, short-term rentals that our clients do are still get reported on Schedule E. The time when it would be scheduled on Schedule C is if you're providing what's kind of called hotel type services. So if you're doing daily cleaning where, like maid services or something like a hotel would do, even though a lot of hotels don't even do that anymore.
That's true. The hotels aren't doing daily cleaning now, right? Because of COVID.
But if you're doing stuff like that, hotel services, concierge services, maybe picking people up and dropping off at the airport, that's more like a Schedule C, more like a business. You're running a business. That would go on a Schedule C. Versus a Schedule E is just if you're not doing that, it's still a short-term rental still goes on Schedule E.
Yeah, this is interesting. This is like an area where I think if you ask 3 CPAs, they'll probably give you 4 different answers. So, all right, we'll take one last question because I know we're over time. So what is this? This is from a Facebook, Alex says.
So it says, how do you determine a cost basis new construction when you and your family members construct 30 to 40% of the structure? Can you allocate some amount to the work done? Does the basis go off fair market value at the time of completion or just add actual costs?
Well, first off, wow, like you build 30% of the home yourself. That's awesome. The cost basis is like it sounds, it's based on cost, not fair market value. So the cost of the materials, the cost of labor that you paid other people, typically doesn't include the cost for your time. And the reason for that is because you're not paying yourself, right? If you did, you'd have to show like some kind of construction income or contractor income to do it, which is not recommended, right? So the vast majority of the time, your cost is going to be determined based on the materials and then the labor that you've paid other people to do the work, not necessarily is what you pay yourself.
Similar answer for Sharon's question. So buy a house at a low price, 100 grand, you do a full gut rehab, maybe put 200 grand into it. You refinance it for, say it's worth 400,000. How does cost seg work? Cost seg is going to be based on your actual cost. So your 100,000 purchase price plus your 200,000 rehab. The reason why it's not based on your loan amount is because you don't have to pay taxes on that loan amount, right? It's just a cash out refi. You get the cash, it's still a loan, you're going to pay it back at some point. So for depreciation purposes, you're based on your cost there.
Yeah, depreciation, cost segregation based on cost, right? The easy way to remember it, not fair market value or anything else. Right? All right, thank you guys. I think we got to answer all the questions in today's time.
Yeah, thank you so much. That was so informative. So many like cost seg questions. I'm glad that that's where that's going because people always ask me like, can I write off a hammer that I bought in Home Depot or something like that? I'm like, that's hardly getting you anywhere, man. You do a cost seg, but where can people get a hold of you? And someone asked me, can they book a consultation with you guys for tax planning?
Yeah, so the best place to find us is on our website, www.keystonecpa.com. So you can download our free ebook. We always try to hold tax updates too, that you can check us out there. We'll try to keep people updated as those come up. But yeah, we also have a tax savings program that we offer. We have one that currently just started. So you can check those out. All that information is on our website. And yes, we do have Ivory, who's our client relations coordinator. You can book consultations with her, not for like tax questions, because she's not a CPA. But if you have questions about like, how do you work with clients? What are some of the things you can help with? That's the best place to go to for that.
And you guys have a book you wrote a couple of books with for Bigger Pockets, right? I remember when you first told me you're going to send me this book, I'm like, I am not going to want to read a book on taxes. Like, I'm not going to get through that. But you do a really good job. I actually listened to both books a couple of times there.
Yeah, yeah. It's you can find them on BiggerPockets or Amazon. The first one is Tax Strategies for the Savvy Real Estate Investor. From the questions today, so that's more for like beginner investors. From the questions today, I think a lot of you are a little bit more advanced, because we're talking a lot mainly about cost seg and not the hammer questions. We also have a second book, which is the book on what is it called?
Advanced Tax Strategies, Cracking the Code for the Savvy Real Estate Investor, I believe.
Something like that. I
Yeah.
just search like Amanda Hahn or Matt MacFarland tax book, you'll see it.
They obviously did not. They asked us for a simple title, right? So
They did. I think BiggerPockets asked us for some suggestions, and then we were vetoed. So then they just chose the titles. But yeah, check those out if you want more information. We try to use client examples, and if I read a third book, I'll definitely include Alex.
Yes.
Or maybe Alex is already in the book. You'll never know. You'll never know.
But yeah, thank you. I can't thank you enough. I'm actually sorry. I know I'm dragging my feet. I need to get you more paperwork so I can get my taxes filed here. But I'm gonna get.
You're not supposed to admit that on air.
Yeah. But hey guys, thank you so much for it was very informative. Thank you very much.
Yeah, thank you.
Thanks everyone.
Okay, see you
Bye.
guys.